Hello and welcome to the latest episode of the Capital Call, I think number 16. I'm Quinn Millegan.
And I'm Drew Millegan.
And let's get into it. It's interesting. The 90 days, we might as well just call this the Tariff podcast at this point, because when we started, the 90-day pause and the tariffs expired, and so now they're back on and all this business. And, if you want to talk about the effects of a tax like that on U.S. citizens, just talk the inflation of the Venezuelan bolivar.
By the way, that's a 2015 50 bolivar. The real question is it 50 bolivars or is it 50 cincuenta bolivars? So that's literally just 50. This is worthless.
Well, it's not worthless.
Well, give it to me. I'll examine it. Give it to me.
What, are you going to rip it?
Yeah, just let me look. Wow. That's worthless. So... it's because
it's worth like $1.
They've had like 1,000% inflation since then. It depends on how they did
2015.
Yes, they've had like 1,000% yearly inflation in many years.
But they would. I'm pretty sure I checked the exchange rate, and it's like $1 or $2.
But that's if you go by I tried it. You have to find an actual inflation calculator. The problem with a lot of those is they go by the official exchange rate.
Yeah.
So you kind of it's kind of murky as to whether it's actually worth something or not.
It's got Simon Rodriguez on it.
Right. And the other problem is that currencies also undergo something called, they do what a stock would call a reverse split, right? So like they have like, if a country endures hyperinflation and yesteryear's dollar is worth 1/10,000th of a current year dollar, they will do a reverse split and now $10,000 is worth $1. And the new dollar they print will be worth 10,000 of the old dollars. So it's difficult to track how much an older note from an economy that's undergone hyperinflation is actually worth, especially considering that usually there is an official exchange rate that is different from the actual exchange rate. And the reason this matters is that the actual exchange rate represents the supply and demand balance between unlimited transfers versus the official exchange rate usually is limited to a certain volume per day, which is usually also only granted to people that are friendly with the local government. So there's a certain amount of nepotism and corruption involved in that exchange rate.
Nepotism and corruption in governments?
Yeah, I know, it's surprising. Never happens, right?
The government would never do that.
Yeah. We've actually got a friend who is Venezuelan, so shout out. She is not living in Venezuela, thankfully. So I'm not going to say her name. But yeah, I swear this was not going to be a tariff podcast. This was going to be a talk about the markets podcast because that's what we do. And unfortunately, tariffs are the topic du jour.
Yeah.
And they keep changing. They're not settling, which is really unfortunate.
And, trading around political whims... Sure, you can make money doing anything, but risky, because unless you have inside information to the brain of politicians, it's any man's game.
Yeah, it's kind of unfortunate. In the years where it took information months or years to cross a continent, you had to rely more, I think, on systems to keep things going for you versus today, when you have an instant information economy, the decisions of one person really can ripple through a society at the speed of information. So I feel like institutions, to a degree, kind of have a little bit of a less of a moderating impact than maybe they used to in some instances. But in other cases, it's good because here in Oregon, during the Great Depression, it took months or years for the effects of the crash of '29 to really reach us here. You talk to the older folks, they'll tell you, things took a while to dry up, just because it took time to move around. So
it's almost like money's on a human scale, and a lot of it is invented.
Oh yeah, it's almost like it's all made up, and the points don't matter. So
I've got more points than you.
Yeah, it's funny. The more you learn about economics, the more you learn where it kind of what it is in a philosophical sense.
Right.
It is important, of course, just as justice or law is important, but it's, you got to remember that it has its limits. It's not really physical. So
I will say I think people like more money, generally.
oh, yeah. I like having more stuff, but there comes
You like being a consumer.
There's a principle they taught us in my basic economic class, which is that there's the declining utility of each additional marginal dollar, right? Like you have that first slice of pizza when you're hungry. You'll pay a decent amount for that slice of pizza. Second piece, yeah, you want to be full, you'll pay, but you maybe won't pay as much as when you're starving.
Yeah.
Third slice of pizza, it's nice to have, but at this point, like maybe you're trying to watch your weight. But if it's real cheap, sure. And then the fourth slice of pizza, you're like, I'm kind of full, but if it's free, I might as well eat it or take it. And then, maybe by the fifth slice, they have to pay you to have it. This applies to dollars as well. There's a reason why, you can buy more the richer you get, but each additional dollar means less and less relative to what you already had.
Right.
So,
by the way, didn't even mention, it's after the close on the 7th, way after the close. Sun might go down here soon, August 7th. And in case you are a new listener, we have at the very end of the podcast, gotta wait till the end, This Day in Economic History. And I've always got some interesting stuff that may or may not be news to Drew. I didn't coordinate with him, so it'll be a surprise.
And that is intentional. I do like to be surprised, although sometimes I pretend not to. So, it makes my reaction more genuine. But interesting stuff came out this week. A lot of stuff to do with broad economic data this week. The jobs numbers are almost never controversial. I mean, they might be surprising, but unless you're a turbo nerd like me, you usually have no idea what they mean. Like, what does that mean? We had 79,000 jobs added in July. Like and we had actually 73,000 jobs added in July, by the way. That was a little bit weaker than expected. The bigger deal
all one person doing those jobs.
All one person just filing 73,000 jobs, and he's having AI do 72,998 of them and only doing 2 of them himself. That's a real thing, by the way. Some people will have. There was a guy in Silicon Valley that was working for multiple startups at the same time and was earning the equivalent of like 5 full-time jobs at competitive startup salaries. That guy was making bank. And apparently he did a decent job too. The only reason they fired him was because of the conflicting priorities.
But you would have been making a lot of money. And so you can do the responsibilities in like 2 hours for most of those roles, so you might as well.
Right. It almost begs the question, like, I don't think he got laid off of all of those positions either. Like, it almost begs the question, like, why not just hire the same guy for multiple different full-time jobs? If he can hack it and you're not seeing a decline in performance, why not?
Yeah.
It kind of goes to show the power of AI in terms of responding and dealing with a lot of responsibilities. But, I mean, this jobs number that has been getting so controversial, though, they did a 258,000 job correction for the May and June numbers at the BLS. And this is what stirred up the controversy because it was a revision downward. And it was not a good look for the administration that had been touting how good the economy was looking before this. And any economist could tell you that these revisions are not unusual. It's actually a sign of good. Not unusual in that they happen. They were a bit large, but these revisions are normal. Like any policy wonk will tell you that these numbers are put out very quickly after the end of the month, and they are based on models and survey data. So then later on, they issue corrections as better data rolls in about the months they already reported. Corrections are not a sign of the failure to do their job, but it's a sign of integrity on reporting the numbers. So you
want them to be able to revise it and not be criticized because there's going to be revisions.
Right. And people need to trust the fidelity of the data. And the fact that people are politicizing it is really discouraging because you would only start ragging on the BLS in this case if you were just being disingenuous. You either don't understand what the BLS does or you're actively trying to misinform people. That's the only reasons to criticize this action. You can criticize them in the sense that maybe they should have a better system so they have fewer revisions. However, there are also systemic reasons why this happens. One thing that was pointed out to me was that over the last decade or so, The Bureau of Labor Statistics that puts out these numbers used to have a much higher response rate to their surveys. And because of that, they've had to rely more on their models to estimate the number of jobs that have been added or lost in a given month. And those models work fine so long as the economy is stable and predictable things are happening. From January through now, predictable things have not been happening, especially with regards to anybody engaged in international trade. So a lot of the assumptions inherent in those models are turning out to be not great guides for where the jobs are, which would go a long ways towards explaining why the number had to be revised downward so heavily. The tariff impacts have really been just huge. And it's happening right around the same time. Like if any folks have listened to previous podcasts, I've said it before, I'll say it again. The real big, you weren't really going to see the big impacts from the tariffs until you started getting reporting coming out right around now in August, September. It's pretty much on schedule, which is, I hate that. I wanted to be wrong. I didn't like this. It's signaling that the economy is effectively just getting weaker just because of policy, which is what it tells me is that if you're going to make inadvisable policy decisions, do it while the economy is strong, because the economy can absorb unexpected outcomes a little bit better than, say, if you're already in a recession or a depression and you hike tariffs because you think you need to protect domestic industries.
Hopefully there's a good resolution and we all resolve this.
Right. One potential outcome that has been pointed out to me is that you could potentially see an impact from the tariffs, assuming they stabilize and they stay stable and they stay predictable. You could see a bump in inflation and a kind of a creative I don't want to say creative destruction, but you could see an adjustment phase as the economy adjusts to where the tariffs have been levied and how much they are, and integrating those costs into consumer prices and business activity.
Well, we got a ring light. It was too dark.
Yeah, I got interrupted in the middle of my rant. But there's a lot of good reasons why the BLS adjusts data, and there's a lot of good reasons why it might have had such an unusually large adjustment. These are very unprecedented moves in policy, and they usually don't happen this fast. For most of I would say most of U.S. history, the executive branch has not had as unilateral of a dial on foreign import taxes. That's really been kind of gradual, and then all at once post 9/11 that the executive branch has gotten all this taxation authority. So kind of in reaction to like the national security stuff that was happening all around. The DHS exists because of that, which people might know today is that their Immigration and Customs Enforcement is under the Department of Homeland Security. So not a lot of historical parallels, I suppose, to the recent movements, but things change, things get faster, and the market adjusts. The one thing that I keep getting pointed out, Quinn, I don't know if this has happened to you as much, but I complain about the tariffs, and then people say, but the stock market's at all-time highs. And the stock market is not the economy.
Also, the stock market is kind of a broad term. You know what's at all-time highs is the Mag 7. You know what else is exempt from tariffs? The Mag 7.
Mm-hmm.
Because of individual deals, essentially.
Yeah, this administration has shown that they're very open to favoritism.
Now that begs the question, do I invest in the Mag 7?
It does, because I mean, it just kind of seems like if you're a small business, you're just kind of gonna get shafted. You know, if you're not big enough to get a handshake, you're gonna get forgotten. I mean, why do they put on banana tariffs? We don't produce bananas in any appreciable quantity in the U.S.
But I would argue that it's a difficult proposition to invest on that alone because it's, again, political whims.
Right. Politics might as well be gambling. Unless you are one of the big guys, you really shouldn't, as an individual, be gambling on national politics.
Is political, if you know that politicians are going to vote on something, is that insider information?
In a moral sense, yes.
In a moral sense, but it's not technically non-public company information.
It's questionable. I am not a legal scholar. I cannot advise anybody in any meaningful context about this. I just know that politicians get away with it individually as politicians because they are the ones that make the rules. Why does Congress get to trade stocks? It's because they decide if they are allowed to trade stocks, and there actually have been bills introduced to curb that to an extent. But there is good statistical evidence to show that there are, and this happens with a lot of stuff. You can keep a trade quiet, but the market sees when additional volume comes onto the market suspiciously close to when something is about to be announced. Now, either people are clairvoyant or somebody knew something they weren't supposed to trade on. And there's good statistical evidence to show that, there are people close to politicians that do trade just prior to an announcement. Now, whether those are people they actually know or just people that got a hold of information, or it's a coincidence and there was another indicator that happened to be aligned with a decision, we don't know. But it does happen.
Yeah. Things happen.
Right. If you're... Here's the thing. If you're doing things fairly in the market, and then you get a call from MarketWatch asking you if you know insider information, it's kind of like getting called a cheater because you're too good at a video game. You're getting too many headshots. You got to be using an aimbot. So it's, if you're playing fairly, it's kind of a badge of honor to get a call thinking you're cheating. We don't do that. But it's interesting to think about because you can't see that somebody is cheating in the market quite obviously. That's
it could also be due to lack of volume because people that are privy to that information are not present potentially.
That's another thing. Is that
because they're not allowed to trade?
That's another interesting caveat to it because, people often think about the decision to do something. They don't think about the fact that when they make a decision not to do something, they're also making a decision. There's no such thing as making no decision, right? Making no decision in of itself is making a decision.
But it's like any position we hold, you're actively deciding to trade that position by continuing to hold it, and it's like selling a company at, let's just say, $10, and then you see it go to $500 the next day. That's a different trade. It's not the same trade you sold at 10. You sold it at 10 for other reasons. The market doesn't care what you paid, doesn't care how long you held, it doesn't care about your feelings. It's a totally different decision the next day, right? I mean, you sold it at 10. You also decided not to buy it back at 11.
Right. It's also a good heuristic, a good sort of gut check. Like, a great way to consider whether it is a rational decision you're making on a stock is, like, if you do own a stock that was bought at $5 and it goes to $500, ask yourself, would I buy the stock at $500? Do I still think it's a good and fair deal at $500 at this highly elevated value? And if the answer is the answer might be yes. The answer might be this company is such a good deal and it's doing all the right things that it's still a good value at this level. And for a lot of people, NVIDIA was like that. A lot of the Mag 7 are like that, where it goes to all new highs, and they're like, it's just going to keep winning.
Yeah. But there's some companies where you're kicking yourself. It's like, I missed out on 5,000% run-up. But the thing is, the only way that I would have made that 5,000% run-up is if I was asleep at the wheel, because that is totally irrational to hold to that valuation on some deals.
Right. Like, you think about the run-up that GameStop had during the meme craze. No way. Even if, like, we actually held a position in GameStop before the meme craze because we saw what the value guys were seeing in it. Over 100% of the float short? What are you, crazy? That's a terrible trade. And we basically took the other side of that. But we were so early that we wound up selling at a much lower profit. But even in the case where we had held into the craze, we still would have sold at like 40, not 500. The same kind of person that holds a 5,000x gain is also going to gamble long odds and lose it all.
Now there's some nuance to that. I mean, you look at an investor like Warren Buffett that's holding like a position in some companies forever, right? And that's a different kind of investment. where your time horizon is basically never selling, right? You're not waiting for anything. You're owning the company. Whereas if you are trying to hold it so you get the top, oftentimes you'll end up losing money because you do get the top and then you don't sell.
Exactly. This is why we always say don't time tops and bottoms. It's a losing proposition. You're doing a technical trade where you're probably not going to be right. And those few times you are right, you remember, and then you forget all the times you lost.
As we were trained on trading, you can't be greedy. You want to leave. I mean, you want to exhibit a certain amount of greed in order to make money on the positions, but you want to leave money on the table for somebody else to then make money, right? As a long-term investor, because if you try to get that last cent, you'll lose, your whole profit.
Right. You'll pay $1 for that last cent.
There's no way, and there's just no way to. If I was able to predict tops and bottoms, I would buy one stock and be a trillionaire by next Tuesday.
Well, you would wind up eventually just accumulating the entire company over time is what would happen.
Right.
It's just statistical impossibilities.
Yeah. And so oftentimes our time horizon's 3 to 5 years. We might enter a position that I would say most of our positions we're initially losing money on because we're buying contrarian value-based investments that other people don't want to look at, and it's not because it's sometimes it's at a statistical low, right? It's close to it, and they might have further to go, but we don't know where the bottom is necessarily.
Right. We just know that it's a good deal at that moment based on the valuations and fundamentals and maybe other things we know about the company underlying it. There's a difference between buying stocks because you've done the work and buying stocks because you've stared at the chart a little bit too long, Not to say that you shouldn't look to the chart for signals, but if that's the only decision you're making, you're basically gambling.
I mean, I disagree with that characterization because, we're
not high frequency traders though.
High frequency trading has its place, and purpose in the market. It's not what we do. We do look at technicals. I mean, 52-week lows, 52-week highs are technicals. It's a data point, but it's technicals.
They're signals.
We do charting analysis. I mean, it wouldn't base everything on charting analysis, but it's one of the details. I wouldn't consider it gambling. I mean, there's a high level of risk to high frequency trading, but
if you're a quant. If you're a quantitative guy and you're a professional trader cooking up algos that you're slinging to Wall Street, that's one thing. If you're an individual using your brain to try and cook up trades just based on a chart, you're a 1 in a million if you really get it right.
Yeah,
is what I would say.
It's difficult. It's still not gambling. I disagree with that characterization.
It can devolve into gambling. How about that? It can be dangerous for the wrong type of person.
Yeah, it absolutely can.
Yeah, that's what I mean. You just got to be careful.
Yeah, high degree of risk. And not we're long-term investors. I'd much rather be a long-term investor.
Mm-hmm. You wind up winning over the long run as a long-run fundamentals person. One thing that is interesting about the market these days is that if you adjust for the top 10 companies in the U.S. markets and you look at the growth of the total U.S. stock market, basically all of the growth over the last six to 7 months are coming from the Mag 7 or the top 10 biggest companies. The rest of the market is still flattered down. It goes back to what you're saying, like the guys that are growing are the guys that are getting tariff exemptions. It's kind of unfortunate. If you're a small guy, a small machine shop in Alabama, and you don't realize you've got to buy a new machine because your CNC machine broke or something, or you got to import some specialized part from Germany or China, God forbid. You might literally go under trying to compete with the tariffs, or you just have to pass it through. It's just really rough out there right now if you're a small business and you have anything to do with import-export, which is more people than I think most people realize. You don't have a lot. I've seen countless stories of businesses waking up to realize they are like some supplier of theirs is actually not domestic, and they had no idea. So I expect to just see more of those, and we're seeing that.
How do we get back on tariffs?
It pervades
it's too much
everything.
On tariffs.
It's too much on tariffs. I gotta stop talking about this, but if I can say just one more thing about tariffs, there's another item in the data that's been reported, which, again, if you're not a policy wonk, you don't watch it. You don't know what it means, and it's the Producer's Price Index. So you look at what's reported in the newspaper, and it's the Consumer Price Index, CPI. That's like the price you pay for rent and groceries at the store. The Producer's Price Index, the PPI, is the price that the grocery stores pay for all the stuff they get, which then gets passed on to the consumer. The Purchaser's Price Index right now is ran at a 7.8% annualized rate in the month of July. 7.8%. Now, granted, it is only up 1.6% year over year, so it's not really catastrophic, but you're starting to see this uptick in the last month or two of data, which, if it is sustained, could be a bad forward-leading indicator for consumer prices. If that rate was sustained, you'd be back at peak COVID inflation levels, and you should start to see that reflected in the stores, depending on what you're buying. And keep in mind, this is data for something that is a monthly figure. It will get corrected, but also that's with tariffs before the August 7th tariffs started getting levied on everybody, just blanket, assuming you didn't get some sort of exemption like Apple did. So these are going to hit harder. The administration has hinted that they want to do 100% chip tariffs. That's microchip tariffs. That would double the price of microchips for anybody using microchips that is not Apple. Not great for those folks that remember what happened to cars when there was a chip shortage. That's kind of a comparable you can use in that case. And we don't really, I mean, yes, TSMC has started producing chips, and there's Intel, of course, but
and we have companies like Lam Research that do different kinds of microchip infrastructure, but we don't have a lot of the very advanced things that they make in Taiwan.
Right. Now, to not be totally doom and gloom, again, you're starting to see more local, domestic upswelling of production. It is actually happening to a certain extent. There's people that did not feel comfortable investing in domestic production that now feel a little bit more comfortable. But most of what you're seeing right now, as far as I can tell, is just stuff that was going to be happening anyways. It's just either accelerated or suddenly they're thrust into the position of being very advantageous of being a local producer of whatever is being cut off from abroad. There was a new process for rare earth metals refining, for example, that was just touted. That was being proffered as like an example of, hey, we can do this in the U.S. And you can do these things in the U.S. Some of these things are literally just because China does it so cheap, there's no point in competing. So there is an argument to be made here that, again, maybe some of this stuff is temporary and we can kind of figure it out, but there's going to be cost pains in the short run, at least. Some of this stuff will take years to get up and running, if you can even get it done at scale that fast.
Yeah.
So, 30% Canada, 25% Mexico, 50% on Brazilian imports, 30% China, and that's just like broad. That's not talking about like specific targeted tariffs.
Like the fentanyl tariffs on top of that.
Yeah, it's just a mess.
But we could talk about tariffs for days.
Yes. Let's talk specific stocks. So, there's a company that we like to follow. I like to follow a lot of companies that have kind of broad impacts where they kind of talk about the broad markets a little bit. You get a little bit more visibility than just looking at the raw reported figures.
And this is not financial advice. Do not trade on any of this because you do not know whether or not we're in it. By the time you listen to this, it could be 10 years later. Do not know whether or not we sold, bought after, or anything changed. So, yeah, not financial advice.
Not financial advice, not direct trading recommendations. There's a company called FreightCar America, which, as the name suggests, originally was based in the U.S., But since it's still within the Americas, it just happens to be south of the border. They moved their production to Mexico. The unions hated that, by the way. I'm sure they still hate them. But
and we are a current holder. We've been a holder of various sizings from time to time. It's an interesting company to be invested in.
It is. And they pivoted in recent years because they had this long period of transitioning to Mexican production. They had very uncertain finances for several years. They've started reporting more broad market trends, which I frankly like to see. There's also shipping companies that sometimes I follow, even if we're not invested in them. We listen to their earnings calls just because they're interesting.
And funny enough, we actually made a recommendation to their senior management that they should talk about general market updates, similar to another company, Starbuck Carriers, that does the same thing. Funny enough, the next earnings call, they are doing it.
I think, I can't take credit, but I think they might have taken my advice. Something might have trickled up to them. They reported that they're now expecting a much softer 30,000 rail cars for the total North American railcar market to be sold in 2025, which is a lower guidance than they were previously reporting in previous quarters. This is interesting because prior FreightCar was kind of expecting to own the market to a degree in freight car production. They own about a quarter of it right now, and they're expecting that to increase.
North American production, by the way.
North American production. Again, not a recommendation to buy. This is known information, but it was very interesting seeing them be a little bit more pessimistic because of broad market trends and not anything they were doing in particular. What that means is that U.S. freight companies are either uncertain as to the future of U.S. demand, or they're stretching out the lifespan of their cars. FreightCar America in particular has a big exposure to the coal space, so it could indicate weakness in power plant, their expected weakness in coal demand. All not great things. Right now, it's probably mostly just expectations. Actual activity is still relatively strong right now, so this could just be U.S. freight companies, U.S. railroad companies taking a wait-and-see approach. They had a lot more interest in, for example, extending the lifespan of existing rail cars. So it's a signal. It's not definitive, but it is concerning.
Yeah. People have been really excited, too, that they're retrofitting. It's in a tiny section of their business, but retrofitting tankers into rail cars.
Yeah, tank cars. Yeah.
Retrofitting. Tank cars, not tanker ships.
Not tanker ships, but it's interesting because it could be a growth business. It's not a huge growth business, but it does add to the bottom line. They've got an extra line that they're going to be bringing online here, but they got hit pretty heavily when the tariffs were announced just because everybody was selling anything that was not in the U.S.
And they're fairly low volume. There is a risk to small and micro cap where volume kind of exits during certain periods kind of irrationally. But then again, that's buying opportunities, right?
Right. If you're an optimist or if you just happen to take a longer view, buy the dip, so to speak.
Opportunistic.
But don't ruin yourself over it.
Like we said, you'll never catch the bottom.
Right.
You might by accident.
But you could certainly be forced to sell if you take too much risk, which is to say over-levering yourself. So be careful. And then the other thing that I think was interesting, there's a couple sectors that are interesting right now. Some people, I don't know if you heard this, Quinn.
Some people
are now expecting a recession of some sort because of the massive revisions that we had and the worry.
We were talking about this earlier. What do you mean? I don't know.
But because of that, you know what does well in recessions?
What's that?
Alcohol. People get drunk.
I know that. Yeah.
People get depressed. They start drinking alone at home.
Well, because it's cheaper than going out, I suppose.
Right. It's an unfortunate correlation, but a correlation nonetheless. And the alcohol producers have been having issues here recently. There's been a decline in the consumption of even just wine, for example. You can kind of track that here in Oregon by the amount of glass that gets recycled, because they go through a lot of glass in that industry. So there's a question of maybe you can find some good deals in that sector if that's what you're expecting. But I find betting on recessions is typically not very reliable.
It's difficult. I would only see it as an added bonus if I was investing in a company that I would like otherwise.
Right, exactly. It would just be like frosting on the cake.
Yeah. If it happens, it happens. If not, it doesn't matter.
Yeah. But the cake has to taste good to begin with.
Yep. if the cake doesn't taste good, you don't want to eat it, and you don't want to have it either.
Yeah, you got to be careful of that fondant. It makes it make the cake look really good, even if it's cardboard underneath. And the fondant doesn't taste very good either. Is it cake? Who knows? Is that a dated reference? I feel like
is Drew caked?
Am I cake? Slice me in half and find out.
No.
No, I am not cake. Allegedly. Good band, though. There's also a question of the pharma tariffs. The pharmaceuticals industry is very dependent oftentimes on production in places like Ireland.
Right, but interestingly, like what AstraZeneca, I believe, is the one where they were talking about, okay, what's your impact if you're tariffed? And they literally just have U.S. production that they will shift it to.
Right.
Like, it's not that difficult.
People were very worried about pharmaceutical tariffs. But again, I look at these companies, it doesn't really take that long to set up domestic manufacturing, and it really doesn't take that many employees. Yeah, they're specialized, but like...
All I'm saying is Moderna's production is all domestic.
Right. It's one of those things where it's not like moving a car manufacturing plant. It's a lot quicker and easier, I think, than some people realize to move that type of production.
By the way, caveat, Moderna's production is not all domestic.
No,
but their domestic consumption is domestic.
Right.
So their international stuff is made in the Netherlands.
By the way, this is the way companies avoid paying tariffs. I say avoid paying tariffs, but it's really not a trick. They predicted initially we'll collect $700 billion in tariffs per month, and they collect like $70 billion, which is still a lot, but it's a lot less. And the reasons are that, well, what happens is often companies will have productions in multiple places or different places, and they'll just be like Apple, and they'll say, okay, we can't sell Chinese iPhones in America, we'll sell Indian iPhones in America, and then just sell Chinese iPhones in India. They're right there. Suddenly, you don't have to pay all those tariffs.
It's like we mentioned before Helen of Troy, which we are currently invested in. They have Chinese consumption of their products. I mean, their actual shift in production was not that difficult because all they did was allocate their Chinese production to Chinese consumption. So you have some kind of these rebalancing of where you're producing it, and suddenly you can avoid a lot of the tariff impact, which allegedly is the point of some of these tariffs. So you would think that when they're predicting how much money they're going to make off the tariffs, they would account for that, because the whole point is incentivizing domestic production or different country production, right? So you're not going to... People aren't just going to willingly pay the tariff. They're going to avoid the tariff if they can.
Right. Like, why would I pay $5 when I can pay $4? It just doesn't make... God knows the government doesn't expect people to change their behavior when it comes to revenue collection. So they just assume the current trends happen forever. And then they institute programs that try to change behavior and are surprised when it changes. It's
like they keep talking about Social Security. It doesn't have the money to pay for everything. And it's not really the whole story, because when they publish those recommendations, they're expecting that they need all of the money for the next 30 years today. That's
actually public accounting of pension funds, which is different than Social Security. But you're basically correct. That's how the government kind of assumes accounting goes.
Meant pensions.
Pensions, yes. Because the way Social Security kind of works these days is people think it's a savings account. If it were a savings account, it would have some of the worst returns ever. What effectively happens with Social Security is that it's an agreement that I pay in now to support the old folks, and in the future, those that come after me will pay for me, is really what it is. And it's basically a direct transfer from workers to retirees, but it's not thought of that way. It's thought of like an investment account, which it's not. I do hope that the Social Security payments are going to be around when we retire, but they keep saying it's going to run out of money. Who knows if the politicians will let that happen, but, stranger things have happened, so it would be pretty devastating if it did.
Yeah. Well, I mean, theoretically, they raise the age and it compensates for it and whatnot. I don't know.
I think we should be like the French and start burning stuff down every time they threaten to raise the retirement age from 55 to 60.
Yeah. When did we ever stop burning stuff down when we didn't get what we wanted?
Some places still do. If Philadelphia loses, they burn stuff down. And, believe it or not, they also do it if they win.
Yeah, it doesn't matter.
It doesn't matter. It's just an excuse to burn stuff down. Gotta love it.
Is it getting close to that time?
I think it's getting close to that time. There's been a lot of stuff that's happened, but I'm sure by the time the next podcast rolls around, there'll be a lot more clarity.
Yeah.
Heck, by next Monday, there'll probably be a lot more clarity.
By the way, it's almost every Monday. Don't at me because we skipped a week or so, going on.
We're busy guys.
And you're
going on.
And you're not paying, $20 a month for this. We're giving this out for free.
Yeah, exactly.
But DM me if you want to pay me $20 a month, because then maybe we'll up the frequency.
Yeah, it might pay for a podcast or two. You never know.
But
this day in economic history.
It's that time for this day in economic history. August 7th.
All right, surprise me. What you got?
Absolutely nothing has occurred ever on August 7th throughout history. I looked back to 6000 BC, saw nothing on the calendar.
I looked at
my Google calendar.
Like I said before, there's no real such thing as absence. Even absence in of itself is a presence of absence.
August 7th, 1914. Following the outbreak of World War I, British banks reopened on August 7th after a rare 4-day bank holiday.
Oh, wow.
Yeah, instituted to stem panic and provide policymakers breathing space. To ensure liquidity, the Treasury introduced, quote, Bradbury notes, emergency paper currency that temporarily replaced gold coin and helped stabilize the financial system.
Heck yeah.
Yeah. And so they basically just extended the holiday one day after another.
They can still kind of do that. It's just really unprecedented.
Yeah, they try to avoid it if at all possible because they want stability. They want stability and predictability.
Yeah, we started this podcast talking about breakers, and they are a thing. They exist to not be triggered.
Yep. August 7th, 1973. On this day, the shocking news broke that Vice President Spiro Agnew was under federal investigation for bribery and tax evasion, a revelation stemming from his tenure as Maryland's governor. The unfolding scandal injected a dose of political risk into financial markets, reminding investors just how swiftly politics can rattle economic confidence.
Man, they really like their corruption over there on the East Coast, don't they?
Hey, them's fighting words.
I'm just saying, I don't see nearly as many corruption and bribery scandals over here, but maybe we just don't have as many people.
Yeah, I wonder. Can we get a statistical analysis? How many of you have been bribed?
Exactly. Answer our survey at FBI.gov, and they probably won't even look at it.
I tried to. One time I got a speeding ticket outside of... No. It wasn't a ticket. It was a...
Quinn, before you continue, don't admit to
It wasn't illegal.
Okay, all right. Just want to clarify. I didn't think it was, but, we're recording.
To my knowledge, I got sideswiped by this car in Hollywood area in Portland outside of a Target. And the lady would not stop. And I had to flag her down. And I was like, you hit me. Your paint's literally on my car. And she was like, oh, there's no way. And then she told the insurance company she didn't do it. And it's like, and the cops wouldn't show up because nobody died and it wasn't a hit and run. But there was footage of it from a Target.
Good luck trying to get the cops to do anything for something like that
and
in Portland.
I went into the Target and they said, we can't release the footage unless you bring the police. But again, the police wouldn't come because nobody died and it wasn't a hit and run. And I'm thinking, I got a $500 deductible. My insurance company said, I don't really care how you get the footage. And I said...
They will remain nameless.
Yeah, we different insurance company these days. And I was like, with the Target security employee, I was like, what about $50?
I'll buy this security footage for $50, please.
And then she gasped, sir. And eventually I went up to $500. That's my deductible. I just want proof that I was sideswiped. Like, come on, you would have given it to me if a cop came here. And she was so offended. Apparently, she could lose lose that target job.
Well, you can say easy knowing I would have taken the money.
I would have taken $500.
$500 to prove something, to prove justice? You kidding me?
It wasn't that. It really was not that deep, but it was not successful.
No, I would have at least reviewed the security footage and determined whether this guy was trying to pull one over on me. But
yeah, she could have at least looked at it and told me.
Yeah, whatever.
Anyways,
we got a lot of integrity here in Oregon.
Not really that related, but I thought it was interesting. August 7th, 2007.
Oh, that's recent.
And
that's right around when the bottom fell out of the CMO market.
Well, funny enough, two things happened on this date.
Okay.
So, August 7th, 2007, at AT&T Park, Barry Bonds launched his 756th home run, eclipsing Hank Aaron's long-standing all-time record. Though it might be a sports highlight, it actually increased the value of baseball memorabilia because of how significant that event was.
Oh.
Yeah.
And nowadays, there would have been a betting market around it.
There would have.
Yeah.
So, I got a couple of long-ish stories. One of them's kind of short. The other one's a bit longer. So, this first one, bear with me for a second. On this date, a major flashpoint in early central banking unfolded. It all began in 1805, when a rumor spread that Napoleon had spirited away the Bank of France's gold reserves to fund his military campaign in Austerlitz, triggering widespread panic.
So many rumors about Napoleon.
This oligarchy-shaking fear caused banknotes to depreciate sharply, trading at as much as 10% below par, as people clamored and questioned the solvency of paper money. As rumors escalated, Napoleon's government stepped in with divisive financial engineering. In April 1806, reforms were enacted that dramatically shifted the structure of the Bank of France, enabling imperial control over leadership. Then, in a bold move of monetary policy, the government capitalized the bank by purchasing 30,000 shares at 1,200 francs each, shoring up the balance sheet. By August 7th, 1807, the panic had been tamed. It was over. The bank held a robust amount in metallic reserves publicly, signifying stability and resurrecting trust in the nation's currency.
And it's very timely you bring this up, given the controversy over the federal board of governors.
Right.
I don't know if we talked about this a little bit, but it's not really that consequential right now. But there was a Federal Reserve governor that resigned early and has now been replaced by Stephen Moran, who was formerly on the head of the Council of Economic Advisors to the president. So that guy's going to be that guy's going to be in office until the term expires in January of 2026. People aren't expecting him to re-up after that date, but they're kind of saying, this is kind of something in the administration's back pocket, where Trump can appoint whoever he actually wants in January if he wants to. And then there's of course speculation about the shadow president, so which we still don't have a conclusion to at this moment. Who knows? Could have happened in between when we recorded and released, but you never know.
Yeah. Here's the other thing, and you pointed out partially what this is related to. So in early August 2007, the smartest guys in the room started hemorrhaging money, and nobody understood why.
Okay, yeah, I'm sure they didn't.
Hedge funds that ran quantitative strategies, complex models that use math and historical data to pick stocks, began to implode. And these weren't cowboy traders taking wild bets. These were buttoned-up, statistically market-neutral funds built by physicists and PhDs. And yet, between August 6th and August 8th, many of them posted double-digit losses, even though the broader market wasn't crashing at that time. On August 7th, it became clear something deep inside the system had snapped. And so what happened? Quant funds often use similar models. Long, undervalued stocks, short, overvalued ones. Adjust for volatility, rebalance regularly. But by 2007, many of them were trading the same crowded positions. Then someone, still unknown...
It's funny how that happens.
Yeah.
That's why strategies work until they break, is because everybody crowds in onto winning strategies or just survivor's bias.
And suddenly it doesn't work anymore.
Yeah.
But so then someone, still unknown, began unwinding a large quant portfolio. probably due to margin calls or liquidity needs. That forced selling pushed down prices of the very stocks that most quants held. Other funds saw their models flash red and started selling as well. And what followed was self-reinforcing feedback, right? One fund dumps, prices drop, other funds get hit, sell to reduce exposure, liquidity dries up, rinse and repeat.
I tell you what, love it, hate it, buy it, sell it, run from it. The panic comes all the same.
Yeah, somebody could edit that into a great song.
Yeah, love it, buy it, sell it. Yeah, okay, yeah, we could. I hope you do that. I don't think you have the time to.
We'll see. It'll be my burgeoning career. We already have it on Spotify. The models couldn't explain it. They were designed for normal times, and this was not normal. Exactly what you're saying. Everyone was running for the same exit at once.
Yeah, it happens inevitably. We just keep inventing different ways to make bets.
Right.
No.
And so some funds lost 5 to 30% in 2 days. And these are usually not very volatile funds. According to a now famous paper by MIT's Andrew Lo and colleagues, these were supposed to be market-neutral funds, designed to make money regardless of whether the S&P went up or down. Instead, they were all bleeding together.
Yep.
Lowe called it a, quote, quantitative liquidity crisis. Not because the market overall was crashing, but because liquidity for certain sets of trades vanished. It was a panic, not on the exchange floor, but inside spreadsheets, right?
Yep.
Strangely, the overall market stayed relatively flat that week. And that's what made it so eerie. Regular investors didn't see it, but inside hedge funds that were doing these quant strategies, it was chaotic.
This actually ties in nicely to what I was saying earlier. You know, like the models, these models are very delicate. They're designed to function in a particular set of circumstances. When those circumstances change, all of a sudden you get these gigantic swings out of nowhere. You know, it's why quants sometimes don't last. And it's why statistical models need to be constantly readjusted.
Because you can build in an exit strategy, but then all the other funds are building in exit strategies, and suddenly the data changes.
They're all doing the same thing. There's this thought experiment in physics. Physicists love thought experiments because it simplifies otherwise incomprehensible logic. And there's this thought experiment where you have an alien that knows the position and direction, and the position and velocity of every particle in the known universe. And you can ask it questions, and because it has this information, it can effectively just predict the future. It can say, like, is this, when am I going to die? And it will say, probably the date you're actually going to die. But if you ask it the question, will the answer to this question not be yes, you reveal the flaw in the system. Will the answer to this question not be yes, Quinn? Tell me. Answer the question.
Cheeseburger.
All right, man. The only winning move is not to play. All right. The point is, it's a paradox. If the alien answers yes, he's wrong. If the alien answers no, he's wrong. And what it reveals is that because the alien is part of the system itself, he cannot ever, in any circumstance, reliably actually predict the future because he himself is part of the problem. The only way the alien could actually predict the future by knowing the position and velocity of every particle is by not interacting with the universe at all, existing outside the universe, at which point you can't ask him questions, which is the same thing with these quant funds, is that they're trying to predict and take advantage of systems that they themselves are a part of. So if you once you interact with them, they work for a time and eventually fall apart. So
this 2007 quant meltdown didn't collapse the financial system, of course, but it revealed major weaknesses. The funds were supposed to be uncorrelated. In practice, they were highly correlated when it mattered most, and their risk models did not account for everyone using the same strategy, as you said. And so it was also a bit of a warning shot. It was one of the first signs that the financial system was under hidden stress. And just 2 months later, Lehman Brothers would begin bleeding assets. And 1 year later, the whole world would know what a real liquidity crisis felt like. Yeah. This was the Great Recession. So if you're wondering how a strategy built on decades of data could suddenly implode in 48 hours, it turns out that past performance is not a guarantee of future results.
Yeah.
It might actually be the reason everything breaks.
Yep, I think it is. The past doesn't always equal the future, unless you're, even if you're a geologist or basic scientist. There's a kind of rock these days that is plastic based.
Is it the actor?
Sure. I don't think he's had work done. You think he's had work done?
I don't know. I don't think so.
Well, I think that's it. I think that's been the podcast, folks.
That's all I have in me. It's past my bedtime.
Yeah.
So, on that note, this has been the Capital Call. I'm Quinn Millegan.
And I'm Drew Millegan.
And I hope you guys stay liquid.
Hey, you took my line.
We both say it. What are you talking about?
Stay liquid.
What he said.